Hi, I'm Kalpana Fitzpatrick. Welcome to the FundForum Best Ideas Breakfast Club. I'm here today to discuss the volatile market conditions and how can fund managers today make money and promote growth and performance as well. And I've got here today two industry experts, Aidan from Aberdeen and Antony from Fundquest. Hello, and thank you very much for joining us. With continuing volatility in the markets, where are you going to make money?
I think it's a good question, and I think the clear answer to me is servicing the clients. In this environment, working with the existing client base, servicing them and paying attention to what it is they need, I think is a key one. I think in terms of business development, I think the answer is going to be more about being part of the managed solution approach rather than just product based.
And Anthony, where do you see some of the key opportunities? Where do you think money will come from for the fund managers?
Well, I think there are opportunities there, but I think in these markets with the volatility, as you rightly suggest, you've got to search much harder for them. And I think there are a number of key aspects to that. I think first and foremost, I think the cult of the pure equity junkie is over. So I think diversification is absolutely critical. Where are there actually opportunities? I think there's opportunities in growth divergence. There are some economies of the world that are going to grow in different ways and diverge, that are not correlated. We've seen that particularly in emerging markets, both positively and negatively, so research is absolutely critical. I think on the other hand, you've got opportunities in high yield, both in terms of dividend yield from good quality companies. Don't forget, good quality companies around the world are still making money and they're paying out their dividends, which is very good. And indeed in emerging market debt and corporate debt. So there are opportunities out there, but you've got to diversify and you've got to do your research in more depth.
And how confident are you that fund managers are actually doing this?
Well, I think it's in our nature to do so. I think fund managers are naturally inquisitive people, and when things aren't going right in terms of where we expect them to go, we naturally look for new ideas and new ways to source returns. After all, as Aidan referred to, that's exactly what our clients pay us to do.
And Aidan, do you see much diversification going on at all? Are clients looking at other asset classes beyond equities?
Yeah, I mean, high yield is a perfect example. There's a great opportunity set in terms of the blowout of spreads. It may have been painful to get there, but the opportunity set is to make money as those spreads compress. And I think what we have to do is look at two sides of it. What's the immediate future hold? How do you handle that? And the volatility and the macro environment dictates the way that behaves right now. But then look further ahead and see where can we take advantage of it longer term. And that may be painful in the immediate term, but it's the robustness of your research and the understanding that you will accept a certain level of risk to get that return in the future. And that's where you've got to look for the opportunity sets. I think that's the big issue for next year.
And the Eurozone obviously is the hottest topic at the moment. Do you have much exposure to Europe, and what are you doing about it? And also, do you see it as an area of opportunity in the long run?
Well, we came into this year, underweight Europe, and I don't think that's a great surprise, or it's not looking back in hindsight or anything. We were underweight in Europe, but you have to say that with globalization, and the UK is a perfect example. It's Europe's our biggest trading partner. Any portfolio is going to have embedded exposure to Europe, even if you have an explicit underweight to Europe. But Europe itself will throw up opportunities at some point along the way. It does feel that we're getting towards an end game. Nobody quite knows what it's about. When we talk to fund managers, certainly a reluctance on behalf of, if you divide them simply between those who take a macro top-down view or those who take a bottom-up fundamentalist view, there is a reluctance to get too caught up in the macro because you can be wrong within 24 hours.
Of course.
But what there is an understanding among a lot of people that one area of strength that's out there is in the corporate sector. So if you're going to invest with corporates, it's better to lend your money to a strong balance sheet than to a government. That hasn't particularly played out this year because of the safe haven trade, but nonetheless the yields available on corporate debt are attractive.
Anthony, and what about your exposure to Europe and when
Well, picking up on Aidan's point, I think what we're seeing in Europe is very much unprecedented in sort of modern investment markets, because essentially what we're seeing markets that are reacting to essentially a political roller coaster as governments and political power and authorities seek to solve the debt crisis. And so in that sense, the market reacts to every piece of political news upwards and downwards, which was obviously bad for volatility. But picking up on Aidan's point, fundamentally underlying that, companies are still making money.
Course,
companies like Airbus Industries, Siemens of Germany, GlaxoSmithKline are still good, strong companies making money in this environment. And so, in a sense, there's almost a slight disconnect between the political worries that are driving market, i.e. endogenous factors, non-market factors that are driving indices, and yet the strong corporate strength underneath that, where companies are still making money. And I think there's an issue about timing. You've really got to look through this. I mean, history dictates that essentially you make 80% of your returns from equities from 12% of the time. And I think the key phrase for investors to remember in that is that for that part, and I think this is the key phrase, for that part of your portfolio that belongs in equities, get in and stay in, because you're not going to be able to time it.
Sure. And you also talked about emerging markets earlier. Everyone's talking about emerging markets. There's a lot of research out there saying that everyone should be having a high percentage of their portfolio in emerging markets. Where do you see some of the opportunities in emerging markets? Is it what you're saying, going back to corporate investing in emerging markets, or is it beyond that?
Well, there's no doubt there are. The emerging economies haven't had the time to get themselves into the debt problems of the developed economies. So, in a sense, you've got a divergence. You've got a slight decoupling at one level. However, the world is much more global. There is an interreliance, and if you look since the beginning of the year, emerging markets are on MSCI are off about 19% as we sit here today. Developed markets are off 12%. So, in fact, you'd have said, well hang on, I would have made a bad call. So again, the key is about selectivity. It's about looking at the growth divergence, looking at emerging markets that do have a strong domestic economy, that are growing in the right direction. I think on that basis, as a house, we would be less favourable towards China, which is much more of a managed economy, and probably more favourable to a country like India. But again, research is key. We make these sweeping statements, but on the ground research of what's available is absolutely critical.
Excellent. Aidan, what's your view on emerging markets, and what sort of exposure do you feel investors should have in this?
Again, two parts to it. I think you've got to take the sort of the immediate short-term view and then the longer-term view. From a longer-term view, let's accept the structural growth story remains in place. So if that is the portion of the global economy where the next consumer is based, where the growth potential from a lower base exists to build. And India is a great example of it. Nobody knows the time in which it comes about, but you can see the opportunity set in it. So the structural long-term story is absolutely clearly in place, and the answer to the question, should investors have an exposure to it, is undeniably yes. The short term is that there's some binary outcomes to it. China is a perfect example. You can line up a group of very qualified, experienced fund managers who will say China is heading for a major fallover, and others who will say, no, they've achieved exactly what it is they want to achieve. And by the end of this year, the chances are that we're going to get an easing of monetary policy in China, and then you'll have almost, not coordinated, but you'll have all of the major banks in easing mode. So, China necessarily won't fall over, but it's a binary outcome in that respect.
Of course, yeah.
So when you look at the short term, I think you've got to be respective of the price being paid, but the answer to the question long term is unquestionably yes. Keep exposure to emerging markets.
And do you have any concerns about the volatility in China? Do you feel it's a potential bubble, and would you hesitate putting a large part of your portfolio in China?
I think what it comes down to is your tolerance for risk. It's as simple as that. If you are a long-term investor, if it's part of the portfolio, Antony made the point about for that portion of your investments, that should be allocated to equities. And within that, for that portion of your investments where your tolerance for risk will permit emerging markets and then China. It's about structure within the portfolio. So you don't have to particularly have a view. In the Chinese world, it's a long-term game. So an element of exposure to it will be appropriate.
So keep your money in there for life, I suppose. And in terms of type of business you're drawing in, is there any particular type of investors that you feel you'll concentrate on heavily, i.e. institutional, consumers? Is there any one direction that you're sort of concentrating on? Either of you?
Well, clearly, being a large international banking group, we benefit undoubtedly from a large captive with a small c, retail investor base in Europe, who have a daily relationship with the bank and therefore would daily engage with the bank and look for opportunities. So from our point of view, we're clearly engaged with those clients in providing sort of managed solutions. And I think for those clients, it's actually about the product doing what it says it does and managing the client's expectation and communicating with the clients very openly about those expectations across an economic cycle. Not very easy when, as I've just said, if a client's put money in at the beginning of the year, they're 12% and 19% down respectively, they're going to say, well, what's going on? So the way in which we engage with clients is absolutely critical in this process, and communication and transparency is key.
Yeah. And what's your experience been so far? How well do people understand what's going on in terms of the retail market?
I think, ironically, if you relate it to investors in terms of them understanding their own budgetary constraints, and in a sense it's taken a lesson from Margaret Thatcher here, who used to say, well, it's just like being the housewife managing the government finances. They begin to understand the problem, the indebtedness problem that's inherent at a government level at the moment. If you relate it to themselves and their own gearing, they begin to understand some of the pressures and some of the problems. But they also begin to understand that there are no easy answers, that at some point you can kick the can down the road, but at some point the debt does have to be repaid. And they begin to understand the sort of structural nature. I think on that basis, investors rightly are being a lot more open-minded about diversification and having much more of a diversified portfolio.
That's interesting. And Aidan, what's your experience in terms of the type of investors that you feel you might target going forward? Is there any particular type, or are you pretty much balanced on this?
Well, I think we're lucky. Aberdeen is an independent asset manager, so it doesn't have a bank attaching to it. So I think in that respect, we look at the broad suite of clients, and certainly on the institutional side of the business. I go back to the first answer I gave, that being part of the sort of managed solution approach is going to be a vital part of how we go forward. So whether it's taking a pure equity approach, or perhaps in the alternative sense, with the evolution of hedge funds into a broader remit into the institutional space, I think that's going to be a very big growth area, and I think it's something that we as a business are very much getting into. But equally, I think for the next year, the education piece and the communication piece with the retail investor is going to be very important, and that's where I think working with your existing clients, explaining what's going on and why, and the implications that it has, is a very important piece of how we work next year.
Of course, and is that going to be probably one of your biggest challenges, trying to communicate to the retail investor?
I don't think it's going to be a challenge. I just think it's got to be something that we've to be very clear and upfront about, and work with the clients. I don't think it's a challenge. It's just what we should be doing.
Excellent. And in terms of your outlook for the year ahead, what do you think is going to happen? Are we heading for a double-dip recession? You're optimistic?
I think we've seen the statement yesterday. I'm just thinking about the government coming along and giving out the growth forecasts cut next year, and you think to yourself, well, where does it really go? I think our base case would be that we probably avoid a double dip recession, but there are certain signs out there that cause you to be cautious about that. It wouldn't be a great surprise. We have a great deleveraging going on, and the implications of that and the exporting of that credit crunch globally will have an impact. And every 6 months we have a new view on how deep it is. So right this moment, particularly the US, and the data over the last few days suggests that perhaps the US is best placed to keep going, and the Fed appear to have taken a view in terms of working towards the unemployment rate rather than just inflation, and I think they're working at that. And don't let's forget, it'll be a political year next year in the States, so there's an awful lot to drive them forward. But I think the US probably avoids it, but we've got to be very, very careful of the data, because I do believe that there will be signs along the way that we have to watch out for. Europe unquestionably, I think, hits a recession, and if Europe hits a recession, then the UK, as I say, being a big trading partner, it will be difficult for us to remain immune from it. Are we going back into a depression environment? Are we going into right this moment? No. The worst case rarely happens. We will find a way forward to it. What form that takes in terms of what the euro is like and how the eurozone comes out of this, time will tell. But I think Europe is the problem area. I think the UK will be dependent on that, and I think the US probably looks better now.
Antony, what's your views?
Well, just to really add to what Aidan said, I think that to some extent the stats are the key. The challenge that we have is that we all want to be naturally optimistic, And what we see every time from successive government forecasts is that they are too optimistic and they're always revised downwards. And I think therein lies the tell. And I also think that as we go through this challenging environment, we're realising just how interconnected markets are and just how structural some of these problems are. And I think for that reason, I would support Aidan's view that we're going to walk a bit of a tightrope. And the optimist in me would like to suggest that we are going to avoid double dip, but it will be close. It'll be a lot more of a closer call than many people think. Yeah. And I don't think we've even begun to see the extent of the austerity measures that some countries will have to make to rebalance their books and how long that will take. In Europe in particular, you can see the very real threat of it going back into recession, which will have quite a knock-on effect on the UK economy. Yeah. The saving grace for the UK economy actually might be the US relationship, in fact, and the US economy is actually proved to be pretty resilient.
Interesting, yeah.
And that may just stave it off for the UK, but it's going to be a close call.
Yeah. So volatile year ahead. If there was just one thing that you could say to the fund management industry in terms of surviving the next year or so ahead, what would your message be to fund managers out there?
I think it would be do what you say you're going to do when you say you're going to do it.
Yeah, clarity of message. I think the strategies that we pursue for different asset classes, I think strategies is the important word as opposed to asset classes themselves. It's how we get that message out and being transparent about it, I think, is going to be important.
Excellent. Thank you both so much for your time. That was really great.
Thank you.
Pleasure.